right, welcome back to Focus Fridays, the series where we open up the playbook on real estate investing from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, head of investor relations here at Focus Capital. And today I'm joined by a special guest, Matt Moore from CamaPlan, a self-directed IRA administrator that specializes in helping investors use retirement funds to invest in alternative assets, including real estate. So Matt, welcome to the show.
Thank you very much for having me. Really appreciate the opportunity.
Yeah, we've been meaning to do this for a little bit now, so I'm really excited for our listeners. Today, we're covering a topic that comes up more often than you might expect in investor conversations. And I think it's a topic that people know exists but don't fully understand how to use. So it's self-directed IRAs and specifically how they can use those funds to invest in real estate. I think most people think of their IRA or 401k as something that holds stocks, bonds, and mutual funds, but they don't realize that the IRS allows retirement accounts to hold a much broader range of assets, including real estate syndications, private placements, and other alternative investments, if the account is structured correctly. So Matt is one of the leading experts in this space, and today we're going to kind of delve into that world. Before we go into that, Matt, I kind of wanted to give you a chance to give a brief introduction about yourself and how you came to CamaPlan and how you got into this space.
Yeah, absolutely. Thank you. So before CamaPlan, I was actually sitting in your shoes. I was raising capital for a debt product, and I worked with accredited investors. So think dentists, lawyers, real estate investors, folks like that, who were looking for another investment opportunity. And it was actually from there that I first became aware of what self-directed IRAs were, because debt works really nicely in a self-directed IRA. So I was working with investors who were using self-directed IRAs. I built a lot of my knowledge there. And then I made the switch over to CamaPlan in September of 24, actually. And I lead the relationships that we build with investment sponsors, people raising capital to help create educational opportunities like this to teach people about self-directed IRAs.
Wonderful. Well, let's start with the most basic question of them all. Like, what is a self-directed IRA, also referred to as an SDIRA, and how is it different from a traditional IRA?
Yeah, and you actually answered this question perfectly. So you're one for one on that explanation from what you were saying earlier. But to reiterate what you said, a self-directed IRA, a true self-directed IRA, gives you access to a wider range of assets than you would with a standard IRA at a larger institution like a Charles Schwab or a Wells Fargo or Fidelity. And I'll refer to Schwab and Fidelity a lot. I'm not putting them down. It's just people recognize those names, so I use them as a reference point. But I say a true self-directed IRA because the word self-directed, or the term self-directed, actually gets thrown around a lot. I personally have a Roth IRA at Chase. And if I open up my phone app, it says self-directed. And it's true. I can choose to go invest in NVIDIA or Microsoft or some other mutual funds or stocks. But a truly self-directed IRA, the kind that CamaPlan holds, allows investors to deploy their tax-advantaged retirement capital into really hard assets is kind of a common theme. So real estate, precious metals, you can lend from your IRA. So you can do quite a bit with these self-directed accounts that you wouldn't necessarily be able to do on one of those, larger platforms with those brokerages. So it's about having control over what you're investing in and being able to really expand the diversification in your portfolio.
Yeah. So I think like referencing, I mean, you referenced Fidelity and Schwab. I mean, they're pretty traditional custodians, and they don't, in my opinion, administer alternative investments because of an operational side of things. It's not a legal thing. The IRS has always permitted, IRAs to hold alternative assets. So it isn't legal. It's a custodial thing. And so when you have a self-directed IRA administrator like CamaPlan that specializes in holding and administering these non-traditional assets like real estate, they can also help ensure the account remains compliant with IRS rules. Is that a correct assumption?
Yeah, I think that's a pretty fair description. Also, the business models are different. So those the companies like a Schwab or Fidelity have business lines where they have portfolio strategies that they are trying to sell to their investors, and if it makes sense for them or for what their advisors are providing to those clients, perfect. Self-directed IRA companies like CamaPlan, we're actually not allowed to sell or endorse any particular investment, which we look at that as being a value add to our clients, because while we are going to try to sell self-direction, of course, we big fans of it. We're not going to try to push you into any one kind of investment. So it really allows the investor to make their choice. I think your explanation, along with kind of the consideration about the business plans of either company and the regulatory environment that the self-directed IRA companies sit in, are all fair descriptors.
Perfect. So while you don't sell certain securities, but you can help administer them. We are on a real estate podcast. That's one of the investments that can be held within an SDIRA. What specifically can an investor hold inside of an SDIRA when it comes to real estate? I know that this is a much broader range than most people expect.
Yep. It's the things that you can hold inside of your self-directed IRA are very, very broad. The most common asset class is real estate, and I'd say that's definitely true of CamaPlan clients, but it's pretty true of self-directed IRA investors in general. Now, what does that mean exactly? Real estate is very, very broad. It can mean investing and holding properties inside of your self-directed IRA. So a single family home or an apartment building. It can mean that you own, and those properties can be domestic or they can be overseas. You can invest into syndications or funds as a passive investor, which I think is a comfortable fit for a lot of people who are going from the standard account at a Fidelity or Schwab and moving over to a self-directed plan, because they don't want to necessarily go through the stress of owning the property outright and their IRA being the landlord, but they want to take advantage of better yield, different asset class. So the private placement or limited partnership structure for a lot of investors is a nice kind of in between, because they're still able to maintain their passive relationship to their retirement account. And then sort of the third bucket I would put under real estate is debt. So people who are holding mortgages or investing into debt funds that are backed by real estate.
Yeah, I think that an important distinction that you made that is particularly relevant for our audience is that passive lever. Most people that I know that have a retirement account don't manage it themselves anyway. They have someone managing it, or they have put it into, one of the portfolio strategies or something like that, and they just kind of let it sit. And for most people, that's actually the best strategy, is just, let a fiduciary or somebody else, a manager, kind of manage that for you going forward, unless you want to be keeping up on it. There's a lot of administrative things on that side. For our investors listening, the most common use case for passive investors that are investing in real estate syndications through their SDIRA is it's the same deal that they might have invested in with their personal capital, but now it's just simply funded through retirement dollars instead. The deal itself doesn't change, and I think that that's something that is particularly relevant, given kind of our podcast material is you don't have to look for different deals. It's just your investment vehicle is different there.
Great point. The risk profile of the deal doesn't, change because it's done through a self-directed IRA versus non-qualified funds or a direct investment. The risk profile is still the same. So if you're investing into a real estate fund or you're investing into crypto, the risk profile is still the same. So really, really great point. The self-directed IRA route is just another capital source that an investor can use to participate in that opportunity.
Yeah. Now you mentioned risk profile a little bit. Let's talk about some of the advantages of the tax advantages of investing in real estate through an SDIRA. What is the actual tax benefit of using retirement funds for real estate investments?
Yep. Well, it really comes down to tax deferred versus tax free accounts. But effectively, you're either going to be not paying taxes today in a tax deferred account or a traditional self directed IRA, or your return is going to grow tax free inside of a Roth IRA. So the traditional IRA and the Roth IRA are the two most popular accounts at CamaPlan. But I would add, these are traditional and Roth. Those aren't specific to self-directed IRAs. Those exist, at standard brokerages too. And so the benefits are just the same. So if you look at investing into real estate, for example, if you hold a property or you're investing into a fund, in the tax-free side, the tax-free growth side on a Roth IRA, you're going to avoid capital gains tax. You're going to avoid income tax if you're getting rental income or on a preferred return in the case of a fund. And so that's going to grow. Tax free, and you're going to be able to take those distributions when you're over retirement age, tax free. On the tax deferred side, same thing. The only difference is there will be no capital gains tax and no income tax at that time. But when you are over retirement age, 59 and a half, and you take those distributions, you will be taxed on those distributions at the tax bracket you are at that time. Of course, we at CamaPlan, we're big fans of the Roth IRAs. So when you as the investor, are able to, convert any pre-tax dollars you have from an old 401k or something, and it makes sense, certainly do it. But of course, that's a tax strategy conversation. That's probably a conversation with your CPA. So you always want to get them involved to see if it makes sense.
Yeah, and it's important for listeners to know that neither one of us are tax professionals. We know a lot of the overlap, but obviously consult your personal tax professional. Matt, you have a lot of knowledge on this subject, and so if I were to summarize this area as kind of like a listener, so the tax advantage depends on the account type, and the two most common would be your traditional SDIRA, which contributions are pre-tax, growth is tax deferred, and the distributions in the retirement are taxed as ordinary income. So investors using a traditional SDIRA for real estate defer taxes on all income and gains until the withdrawal. And then for a Roth SDIRA, those contributions, because they're post-tax, the growth and qualified distributions are completely tax-free. And so for real estate investors, this means that appreciation, cash flow distributions, and profit at exit can all compound and be withdrawn tax-free if the account rules are followed correctly. Obviously, retirement age plays a role in that. And so that's why the Roth structure is more preferred in this case and is more compelling for long-term wealth, building vehicle. Would that be a safe assumption right there?
Yeah, that was a perfect summary. The only little asterisk that I'm going to put on is when we talk about UBIT, or unrelated business income tax. And I think it can kind of go in the weeds a little bit, but it can sound a little bit scary. But if you know about it, then you realize it's not such a bad thing. So should we go into UBIT? What do you think?
Yeah, let's go into UBIT. So unrelated business tax and unrelated business income tax, or UBIT, also referred to as UBIT. Can you explain what that is and when investors need to think about it?
Yep. I'm going to speak at it. I'm going to keep it at high level. And I'm also going to speak at it from a real estate perspective, because I have a lot of listeners are interested in investing in real estate. So as you said, UBIT, UBIT, unrelated business income tax. This is a tax that is assessed on certain investments that are held inside of an IRA. So we know that, generally speaking, just on going back to 45 seconds ago to that great summary you just provided, that qualified funds or retirement accounts are generally tax advantaged. Either they grow tax free or they're tax deferred. UBIT happens when a retirement account's investments start to act more like a business, or if there's leverage being used. The business part, gaining profits, we're not going to talk about that, but leverage is in a real estate transaction is a little bit more common. So when leverage is used in a real estate transaction, this is a trigger for UBIT, and the trigger is called unrelated debt finance income, UDFI. So we have UBIT, that is the tax, and then it's being triggered by, in this case, debt or UDFI. So when a real estate investment inside of an IRA is using leverage or debt for the investment, the IRS is basically saying, okay, you're taking money out of the financing pool. It's inside this tax advantaged account. This is kind of beyond the spirit of what these accounts are. And again, you're taking money from potentially another borrower. So there needs to be some kind of mechanism to make this fair. So when you are using debt in a real estate deal, for example, your income, like rental income or preferred return, that is attributable to the amount of the loan. So if it's a 70% loan to value loan, then 70% of the income, the preferred return, for example, can have UBIT assessed on it. And then 70% of the capital gain is the same thing. Yeah. So we don't like tax, just like people generally don't like paying taxes, but there's two positive ways to look at UBIT. Number one, or I'd say three. Number one is UBIT's not going to be assessed unless the deal is making money. So that's if you are making money, then you are paying UBIT, but it's still you're going to generally have in a profitable deal. Number two is that depreciation is often something that investors really like about real estate, but when you invest through a self-directed IRA, you don't get that depreciation benefit because it's already tax advantaged. However, you can use depreciation to actually offset UBIT. So it can actually reduce that liability. And then the third thing is we look at UBIT as generally being a positive thing because the IRS could say, no, you can't use leverage on deals inside of an IRA. So they've created this mechanism to allow people to, increase their buying power of their IRA, use debt in deals, and participate in bigger deals. So we think of that as a kind of a net positive for deals that you can do inside of an IRA.
Yeah. I think that's a really relevant thing to bring up here because virtually every syndication, and we're a retail syndicate, real estate investment syndication, uses debt financing or debt leverage. And so when you talked about LTV, our typical average LTV is between 70 to 73%. So for our investors, that would be the number that they would want to pay attention to when they are, talking to their qualified tax advisor and looking at that model there. And then important for that LTV is the portion of the income that's attributed to the leverage portion. So like when we have anywhere between 30 to 35% of it just coming from our LP raise, they're not responsible for anything on that side because there is no debt financing or debt leverage on that side that they're going to be having to include in UBIT. One of the things that I wanted to also talk about, so we talked about that lever, but also there are also prohibited transactions within an SDIRA, and they matter a lot. So this is where I know that investors need to be careful. So what are some of those prohibited transactions and what happens if an investor crosses that line?
Great question. So there's kind of two ways to answer this question, or two sides of the coin. So earlier you asked about what people are investing in, especially in real estate. So to answer the prohibited transaction question, we can also look at things that you're not allowed to invest in. Generally, it boils down to two things: life insurance policies and then collectibles. So like rugs or baseball cards, things like that. The other side of the prohibited transaction coin is making sure that you're keeping everything at arm's length. So your retirement account cannot benefit from you personally because it is its own entity, nor can you benefit from your retirement account personally. The easiest way to illustrate this is if you were to own a property as an investment. So imagine you bought a property in Orlando, Florida, and that property needed a new toilet. And so you wanted to go and replace that toilet yourself. If you own it inside of an IRA, you can't go and do that work yourself because your IRA would then be benefiting from your own sweat equity from you, the individual. So you need to pay a professional to go and make that improvement themselves, and you would compensate them. Their compensation would be taxed, their income would be taxed. So that's kind of example one. On that same example, if you wanted to take your family to go to visit Disney World and you said, okay, I'm going to go stay in my property that I own in Orlando. If that property is owned inside your IRA, you can't go and stay there because it's owned inside your IRA. You can't personally benefit from that. So that's kind of layer number one. Layer number two is that your family members or certain family members also are prohibited from benefiting from the IRA or vice versa. Anyone of lineal ascent or descent, which in plain words, it means no grandparents, parents, spouse, children, grandchildren, or their spouses can benefit from your IRA. So again, using a real estate example, imagine you bought a 4-bedroom property in Austin, Texas, and your plan was that 3 roommates were going to stay in that place, and then you had a daughter who was going to go to University of Texas and stay in the 4th bedroom. Well, if that property is owned inside the IRA, she can't go and stay there because she's a prohibited family member from benefiting from your IRA. So just some things to consider there. We at CamaPlan have kind of a couple ways to protect against this a little bit, because we ask investors when they're just getting started what they're planning to invest in, so we can kind of get a feel for what they're doing and understand the nuances of the transaction, and just basically talk it out with them, especially if they're new to self-directed IRAs, which a lot of people are. And then the second layer is when that investment is being processed and the transaction is going to go through. Our operations team is looking at the investment paperwork, and one of the things they're looking for is to make sure that the investment is going to be compliant inside of an IRA. These are ways to just help investors make sure that everything's arm's length and avoid any issues with the IRS later on down the road.
Man, and this is why working with an experienced administrator and a qualified tax advisor is not really optional in this space. I feel like there's all these nuances where it's like, understanding the game and using this to your advantage can reap real benefits, but also like making sure that you're paying attention to all these nuances within your SDIRA. I think one of the follow-up questions I have to that is, what is the practical process for using an SDIRA to invest in a syndication or anything like that? So walk us through the mechanics. I understand now the benefits, the tax advantages, some of like the tax implications when it comes to UBIT. I also understand stuff that's prohibited and that there will be penalties from the IRS if I cross that line. But if someone is listening and wants to invest in a focused capital deal through their SDIRA, what does that process look like if they were to come to like CamaPlan and they're like, I have retirement accounts, what do I do now?
Absolutely. So I think the first step is listening to something like this or watching something like this, so you have the baseline of understanding and you know what questions to ask, and you talk to someone like yourself to understand the deal and what you're getting into. But once they have their deal in mind and they want to use retirement funds to invest in it, things are pretty straightforward. It's basically 3 steps. There's more that goes on in the background, but it's really boils down to 3 steps. They open their account with CamaPlan. That's a 15-minute online process, very, very fast. During that account opening step, they indicate how they're going to fund their account. You can fund your IRA 3 ways. You can put in brand new cash. You can make a contribution. You can do a transfer, or you can do a rollover. If you're investing into a syndication, for example, or a real estate fund, and those are generally going to have investment minimums of $50K plus. So a contribution where you're capped at $7,500 per year is probably not how you're going to be funding the account for this investment. So that brings us to transfers and rollovers. A transfer is going from IRA to IRA. A rollover is going to be usually an employer plan, like an old 401k or an old 403b, and you're going to bring those funds over to your CamaPlan account. So you open your account, you tell us how you plan to fund that account. If it's going to be a transfer, we'll receive that paperwork or that information from you, and we can actually initiate that on your behalf. If it's a rollover, you as the investor will have to reach out to your old plan administrator and direct them to send us a check or wire the funds. We can help with that process, but that if it's a rollover, it has to be initiated by the investor themselves. That time for getting the money from one custodian over to us is generally 2 weeks. It's just sort of the industry standard. But while we're waiting for that money to come over, we can then work on what I consider to be step 2 of the process, which is making the investment. What we're going to need is the asset purchase directive, which is our form, and that's you telling CamaPlan how you want to direct your funds, and then also the supporting investment paperwork. So in the case of a syndication, like what Focused Capital does, we would ask for things like the articles of formation, operating agreement, subscription agreement, and the private placement memorandum. We like to work directly with the investment sponsor themselves because we want to make it easier on the investor. So generally, if I'm talking to you, Jared, I would say, hey, we have this investor who's coming over. Can we get these documents? Because you and I know what we're talking about just a little bit better than what the investor does. So we can make it easier for everybody. But yeah, we get that investment paperwork on hand. The investment agreement or the subscription agreement is going to be titled to the IRA. So it's going to say CamaPlan FBO for the benefit of Matt Moore IRA, not just Matt Moore. And CamaPlan will be the one who signs it. So now we have the investment paperwork, we have the asset purchase directive, and the funds have come over. Once we have all those things, in 48 business hours, we'll send the funds to the investment sponsor or to the seller of a property if it's a real estate transaction. And now your investment is active inside of your CamaPlan IRA. And so the distributions or from that fund, for example, go into the IRA, just like dividends from a stock, or if there's rental income from a property, that goes into the IRA. And the same rules apply to our IRAs, just like they would to one at Fidelity or Schwab. You can only take distributions out when you're over 59 and a half.
Gotcha. Yeah. So all of that seems super simple and straightforward, and working with someone like a CamaPlan and Focused Capital is easy because our investor portal, cash flow portal, all the documents are up there. They're familiar with the landscape and the platform itself. But one thing that I would kind of highlight that Matt had said is timing. So investors who wait until a deal is closing to start the SDIRA process often miss the window because of how not the administrative side of things, but it's just industry standard that waiting for funds from your current custodian or custodians to transfer into your SDIRA account can take anywhere between 1 to 2 weeks. And so starting the account establishments process well in advance of an anticipated investment is very important, because you could know today, for a deal that we have right now, it closes 4 weeks from now. Somebody already knows that they're going to want to go down this path, then they can already start that process now. even if they're not planning on funding this for another 3 or 4 weeks. It's actually more encouraged to do that now.
Absolutely. And I think 4 weeks out is a great time to start. Like, I wouldn't say it's ahead of schedule. I'd say now is the time to start, just to give yourself some cushion to make sure that you're not under the gun to get things done. Life does happen sometimes, and you just want to make sure you're not stressing over this. There's already, there's some anxiety and stress just associated with investments. There's risk. That's just is what it is. There's no reason to add more to it because you're trying to brush things through on the self-directed IRA side. So I think giving yourself 4 weeks to start and then ultimately have your money deployed is kind of the ideal timeline.
Perfect. Matt, I have 2 more questions for you before I have to let you go. The first one is this strategy right for everyone? Or are there specific investor profiles where it makes the most sense? Like what types of investors tend to benefit most from this type of strategy?
Great question. And I think that investors who are already investing into alternative or private investments, they're the best ones to consider this strategy. It's not always going to be a great fit for people who want to use an advisor or a manager of their money to be placing their investments, and that's fine. It's not for everyone. But if you're someone who's already comfortable doing your own due diligence and investing into private deals, then just like we said before, this isn't about a new risk profile because you're using IRA capital. It's just a new source of capital. So if you are already interested in doing these deals, this is something that could be a great way for you to, do even more deals through your retirement funds. I'd say one other consideration is if you ask someone to invest, $50,000, $150,000 into a deal, and they're thinking about college they have to pay for, or a wedding that they have to pay for, or something like that, and it's an illiquid investment or a slower return of capital, the timing of an IRA might actually benefit or align more with kind of what's going on in their life than just making a direct investment. Because, for example, if you're 50 years old and you're looking at college tuition that you need to pay for, doing an investment from an IRA isn't really going to hurt your walking around money, because you can't touch that money without penalty anyways until you're over 59 and a half. So investing from an IRA might actually align with your timing a little bit more than just making a direct investment. So something else to consider there.
Yeah, I think that I always like to talk about who this benefits and who this benefits the most, and maybe who it's less compelling for. One other thing that I would probably bring up is it's probably less compelling for investors that have maybe small retirement account balances relative to minimum investment thresholds on what they're looking to invest in. And that's anything, even outside of real estate. But, for, like you had said, like, and multi-family real estate syndications start at 50 to 100K plus. Our minimum, check size here is 200K. And so if you have a newer retirement account and you're not going to be putting additional funds into it, and then also knowing, your annual contribution limits, if you only have 30K right now, it might be better managed in, one of the many portfolio funds that your current custodian has. And so while I think this is super beneficial for people that are already investing in real estate syndications with personal capital and want to extend that strategy into their retirement portfolio, or in a tax bracket where the tax shelter event of an SDIRA it provides the greatest marginal benefit, there's definitely a few key people where this would be a better benefit later on down the road. Last question. What's a mistake you see most often from investors who are new to this, or new to this process, or new to SDIRAs?
The first mistake is just not knowing enough about it to begin with. And so not doing their own homework, just the same way it would be a mistake not to do proper due diligence on a deal, which would lead you to either getting into something that you don't understand, or preventing you from participating in something that could be of great benefit. So I think not knowing enough ahead of time is probably mistake number one. Mistake number two, what you brought up about timing, is definitely something that we see pretty often. People trying to rush into deals that they really don't have the time is not on their side. And yeah, I'd say the last thing is just probably some on the kind of the examples that I gave on the real estate side is people who are trying to do deals that they really can't be doing the way they imagine because it's going to be a prohibited transaction. And so I think understanding what you can and can't do, which I guess ultimately just falls into sort of that due diligence and research side that I mentioned earlier, will help make sure that you're making good investment decisions for your self-directed IRA in the first place.
Yeah. So for anyone, that I would encourage you to re-listen to this episode, especially if there's certain parts that you want it to go over again. It's important to remember a self-directed IRA isn't a loophole or a workaround. It's a legitimate IRS-sanctioned structure that allows for investors to put retirement capital to work in asset classes that have historically delivered strong long-term results and returns. And if used correctly and compliantly, it can be a meaningful part of a sophisticated investor's overall wealth strategy. If you have any follow-up questions, you feel free to reach out to either one of us. Our listeners can reach out to us at investors@focuscapital.com. Matt, how can listeners reach out to you?
Best way is to reach out to me directly, mmoore@camaplan.com. So that's MMOORE@CAMAPLAN.com.
Perfect. Matt, thank you so much for being on the podcast with us today. Everybody who has any SDIRA questions should definitely go to Matt. He's an expert, like we said, and CamaPlan is a trusted partner of ours. And so for anyone looking to kind of make that strategic maneuver with their investments, CamaPlan is definitely the way to go.
You're very, very kind. I appreciate it. And really, I love talking about this stuff. So I encourage anyone to reach out with your questions. And I just want to say once again, thank you very much for this opportunity.
Yeah, thank you so much. Have a great rest of your day.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.